Welcome. This presentation will review forecasting expenditures for Massachusetts cities and towns. This is the third and final piece of the three-part series on revenue and expenditure forecasting. This spreadsheet shows an example summary view of a municipality's expenditure forecast. Note that the projection provides a 5-year outlook, which should be included in every city or town's financial forecast. Having developed the revenue projections, it's time to work on the expenditures. The process continues to be data-driven and requires collaborative input among financial officers and policymakers. With a collaborative approach, various viewpoints and expertise of participants are represented and incorporated when developing forecasting assumptions. When developing expenditure assumptions, we recommend the community adhere to its financial policies on capital planning, indirect cost allocation, debt management, and employee benefit-related liabilities. As with the revenues, the expenditure forecast should be continually reviewed and adjusted as needed. Policymakers must annually determine a well-defined budget approach for forecasting expenditures. Local officials have 3 general options to choose from when doing so. A maintenance or level service forecast projects the costs needed to maintain the current staffing level and mix of services into the future. Because of contractual obligations and the impact of inflation on expenses, a maintenance budget will be greater than the prior year's appropriation. A level funded budget appropriates the same amount of money to each municipal department as the prior year. This would represent a budget cut if there are increases in mandated costs and other fixed expenses that still must be funded. A third method is to adjust expenditures by a specified percentage increase or decrease either across the board or by department. Historical trends should serve as a baseline for projecting current service levels into the future. Municipal departments should be grouped by major categories consistent with town, city, and state expenditure reporting. These include general government, public safety, education, public works, health and human services, and culture and recreation. Within each of these categories, expenditures should be distinguished by salary and wages, service and supply expenses, and capital outlay. Local officials should also compile data on their community's fixed costs. These include employee benefits, such as health insurance, pension, and other post-employment benefits, risk management, such as property and vehicle insurance, public safety injured in the line of duty, and workers' compensation, debt service, and state assessments. Personnel costs, which include salaries, wages, and benefits, typically account for 75 to 80% of a community's budget. Cost of living adjustments, step increases, stipends, and other types of pay tied to base salaries must be incorporated in this part of the forecast. Employees should be grouped by collective bargaining unit or compensation schedule when factoring future salary and wage projections. In addition to the base salaries and wages, these future projections must include all compensation types, such as overtime, stipends, differentials, and other payroll classifications. As noted in the previous slide, when forecasting personnel costs, it is important to only include contractual cost increases, salary step increases, and other known obligations in the departmental section of the forecast. This is important because the purpose of the forecast is to determine available revenues to fund new costs, such as raises and collective bargaining agreements. A well-formulated forecast allows for the impact of future wage increases to be clearly demonstrated. A below-the-line presentation of new wages, example shown here, is an effective method to utilize. Service expenditures, such as technology and office equipment contracts, utility costs, building maintenance, professional services, and other general supplies should be included in the forecast. Current expenditure levels should be used as a baseline for the forecast. An assumed rate of inflation or service contract increases can then be used to project future costs. Departmental capital outlays should also be included. These are appropriations within the annual budget for the routine replacement of tools, equipment, and vehicles that are not eligible for capital funding per the municipality's capital planning policy. Fixed costs, such as employee benefit expenses, are not included within the department budgets and should be accounted for separately in the forecast. Employee benefits include group health, dental and life insurance, pension, Medicare, and other post-employment benefits. The cost of health and life insurance is based on the provider's plan, the percentage of premiums paid by active and retired employees, and the number of enrolled employees. Based on these factors and historical trends, officials should project a reasonable percentage increase and closely monitor actual costs. Appropriations for pension costs are made according to a payment schedule approved by the Public Employee Retirement Administration Commission, or PARAC. This should be changed every 2 years to reflect the revised schedule as approved by PARAC. A 1.45% Medicare tax is withheld from the paychecks of employees hired after April 1, 1986. The forecast needs to include matching funds that must be paid by the community. Contributions towards OPEB liabilities should be made per the local funding policy. Risk management costs consist of workers' compensation, public safety injured on duty, unemployment compensation, casualty and liability insurance, property and auto coverage, and public official bonds. As with employee benefits, risk management costs are not included in departmental budgets. Based on historical fluctuations and claims history, a reasonable projected increase should be determined. A community's capital improvement plan for assets, including buildings, land, infrastructure, and vehicles, should be built into the forecast. Funding for capital items comes from taxes, debt, and capital exclusions, free cash, retained earnings, stabilization funds, and other reserves. A community's financial policies should drive changes in the capital plan and be reflected in the forecast. Enterprise fund capital and one-time expenditures should be built into the fund's budget and offset by estimated receipts and certified retained earnings. Community preservation capital should also be reflected in the forecast, offset by estimated receipts and available fund balance. A community may issue debt to finance the construction, reconstruction, or acquisition of infrastructure and other assets, or to refinance existing debt. Debt includes general obligation bonds, revenue bonds, bond anticipation notes, lease purchase agreements, and any other obligations permitted to be issued under Massachusetts law. Debt service is the repayment of the principal and interest on a bond issuance or other obligation. The existing debt schedule must be used as the base for all years of the forecast. Debt may be issued and accounted for in the general, enterprise, or community preservation funds. The treasurer is responsible for debt issuances and management and should provide all information related to existing debt obligations. Amortization schedules and a municipality's capital plan should be used as a basis for projecting new debt service. A community's capital planning and debt management financial policies should govern the issuance of debt. Regional school district member communities should ensure that any debt obligations issued by the district are included. For projecting potential impacts, a debt service calculator can be found on the Division of Local Services website. A community pays state assessments for participating in various state and regional programs. These programs include mosquito and air pollution control districts, the Registry of Motor Vehicle Non-Renewal Surcharge, and regional transportation authorities. Those communities participating in charter and school choice programs will also have sending tuition assessments. Officials should review historic assessment data for each program the community participates in when projecting increases for the upcoming fiscal year. The formulas used to determine assessments should also be reviewed. Actual assessments may differ from initial state estimates as final data becomes available. An enterprise fund gives a community the flexibility to maintain a separate accounting and financial reporting mechanism for a municipal service for which a fee is charged in exchange for goods or services. Example enterprises include public utilities such as water, sewer, and trash disposal services, cable television access and broadband, healthcare services such as ambulance service and nursing homes, recreation facilities such as a skating rink, pool, beach, and golf course, and transportation infrastructure such as airport, dock, and wharf facilities. Enterprise fund expenditures should be organized the same as the general fund by breaking out spending by salaries and wages, services and supplies, and capital outlay. The fund's forecasted direct costs should be based on historical trends. The fund's indirect costs provided for in the general fund, such as insurances, employee benefits, and administrative costs, also need to be accounted for. This amount will be charged to the enterprise fund through an inter-fund transfer. Total fund expenses, both direct and indirect, offset projected revenues from services provided. If recurring revenues are not sufficient to cover total fund expenses, then the fund requires a subsidy from the general fund. This determination should be set in a community's financial policies. Community Preservation Act funds are used to preserve open space and historic sites, create affordable housing, and develop outdoor and recreational facilities. Expenditures from the Community Preservation Fund are treated as an offset to projected revenues and are grouped in two categories. The first category is for spending required by statute on community housing, open and historic spaces. 10% of fund revenues must be spent in each of these areas. The other category is expenses for administrative, capital, and debt service. Up to 5% of CPA surcharge revenue can be reserved for administrative expenses. Debt should be projected according to the existing payment schedule. Capital projects funded from the reserve and undesignated balances are not detailed in the forecast. Any projected revenue balance should be recognized as a contribution to the undesignated reserve to balance total revenues and expenditures. In closing, here are some key takeaways to remember when your community is developing its forecast. All members of the financial management team should be involved. Financial policies should govern how the forecast is developed. These policies should be reviewed and updated as needed. All assumptions should be realistic, concise, well-documented, and conservative. Continually update the forecast as information becomes available. Brief policymakers on the forecast periodically to keep them informed. Finally, do not base revenue projections on the city or town's spending needs. Any gap between revenues and expenditures should be balanced during the budgeting process. For more information, please visit mass.gov/DLS.